So how much is that when you consolidate? What do you get? How much? 23.39. Next, investments. Investment to replace them with goodwill. So goodwill, how much was the goodwill on acquisition? So instead of recognizing the investment, all of it was just in the company investment. Goodwill was how much? Yes. 40,000. Then we invested in the associates. Associate, we had some investment. That working one, the one you were talking about. So you say investment in associate. Investment in associates. How much? 15,000. So total non-current assets is how much? $25. All right, then current assets. Current assets, we have inventory. So inventory, you take 165 plus 160, then you subtract the unrealized what? Profit on inventory, UPI. So which note was talking of the unrealized profits? Which additional information? Note number 4. Risiki, unrealized profit still. Note number 3. During the year, Salama sold goods to Riziki for 64 million, earning a gross profit margin of 25%. Riziki still held 48 worth of these goods. So unrealized profit is based on the goods which was not done what? Sold. So UPI is equals to profit margin. 25% was profit margin. So it is 25 times what? 48. You base it on the goods which remain. And realized profit is based on the goods which remain. How much is that? 12,000. So unrealized profit is 12. Subtract it from inventory because it's affecting, it's overstating our stock. So minus 12. How much is that? Gross number 230. Then receivables. $247,100. plus 107,800 receivables you subtract intergroup debts. Mara huyu bado amekuwa na deni ya huyu ako na deni ya huyu mwingine. Kuna note number, exemption note 3. They were saying, however, Salama Limited still had the full invoice value of 64 in trade receivable. However, Riziki Limited's trade payable only showed how much? 34, as it had made a payment of 30. So the correct balance, the correct intergroup balance is how much? 30 which one? 34. But the 30 is called cash in what? Transit. So subtract intergroup debt, then also the cash in transit you subtract from receivable. Washe kudai because washalipwa dawa. So minus 30. 30 is the cash in transit, while 34 is the intergroup debts. Intergroup debts you eliminate from receivable and payables. So how much is that consolidated? Copy? $290. Next, bank. So bank, you add 21 plus 13.8 plus what, Steve? Plus what? I'm going to do cash in transit 30. See, unaongeza cash in transit. Yes. So plus 30, which is in transit. How much is that? So this is 21 plus 13,800 plus cash in transit of 30. You get 64,800. So what is the total assets? Total assets will be how much? You get total assets of how much? Huh? Ona leo nyinyi muongee. Yo bila sita ndio. Rose. Hii addition ya class 2. 32 63,400. 63 because the inventory is 3,000. Inventory alipea figure mbaya. Less than 100. Oh, you continue giving me bad figures. 313. And you thought we are going to copy. Alright. Let's go to equity and liabilities. Gross cleaning. Ati Joshua anasema receivable should be 320,900. Kwani hii kuongeza hizi vitu imekuwa ngumu? 320,900. Kuchukua 247 Joshua 247 plus 107,800 minus 34 minus 30 290,900. Joshua weka na hiyo 320. Ndio unajua kwenye naitoa. Ordinary share capital ordinary share capital in group accounting, ordinary share capital we take parent only because your subsidiary inakuwa imechukuliwa ukitafuta goodwill na hiyo ingine itachukuliwa na minority here as part of their capital. So you only consider the shares of the parent. So, but now in this case is only gonna issues. There are some shares parent gave out when they were acquiring the subsidiary. You remember it was what for what? 2 for every 3. Yes. So you need to check those shares which parent gave out. Then you add with the ones of the parent. So you have an outside working, you say ordinary. Joshua, kwa nini utoe hiyo 30? Because usipotoa 30 inakuja hiyo figure unasema hapo. Ordinary share capital. The parent gave out 2. They gave out 2 shares for every 3. So, times the number of shares they did what? Acquired. 75%. 75% of what was the share capital in that company? 30. We divided by the par value. Sure. Times what was the market price? Market price was 16, but in ordinary, you don't record anything above the par value. So here we multiply by shillings what? 10. Then the excess of 6 will go to share premium account. So, I work out that. Exact. For hiyo tunakuja ngapi? Those shares they gave out 150. So this is 150. So the difference, you know, the market value they gave out a market value of 16. So the excess of 6 will go to which account? Share premium. The amount which is over and above per value is for premium. So share premium you will take the same 243 times 75 times 30, but this time around we multiply by select what? 6. You know, 90. Pass. So in consolidation, please top up these ones because they are not there in the books. So let's go back. Let's go back. Ordinary share capital, you take the ones for parents, 850, plus the ones they gave out, 150. We don't add shares for the subsidiary. We had already taken it when we were doing goodwill. Balance the bank with the fair minority. 850 plus 150 is how much? 1 million. Share premium. Share premium. It was not there before, so we just record this one here. 90. Then retained earnings. Retained earnings. Retained earnings. That is a working which we have to do. It's a working we have to do. Retained earnings is a working we must do. So I have a working outside there. But retained earnings, kuna working like mbaya hata usijisumbue kwa mtihani fulani. Retained earnings na kina NCI ni waste ya time. But let's work it out. So retained earnings. Retained earnings. So for the parent, check retained earnings of the parent in the balance sheet. So retained earnings, the retained earnings carried down. It is how much? 743, 743, 400. Give us there. Then in the for subsidiary, bring what is called post acquisition. So you bring the profit which that company made after you acquired them. After you acquired them. So I think that one we calculated. Come on. Come on to the pair. It's easy. For Salama, check this one here. Salama on the date of acquisition, check paragraph 1. You know it was acquired. When was Salama acquired? Here. Exactly the beginning of the year. Yes. What was their retained earnings? Check, I think paragraph 1. It was 234. Yeah, if you check paragraph 1, their profit was 234. At the end of the year, check their balance sheet. How much is their total retained earnings? 358. So post-acquisition is the profit that company made between here and here after you acquired them. That is what you need to bring as time goes by. So for Salama, parent will take not everything, but just 75% of 358 minus what? 234. The increase in profits. I'm getting 93. Check to confirm. Sure. Then there are some elements which affect this profit of the parent. So you less them out. So less depreciation. Depreciation will be what? How much was depreciation? Depreciation was 120 over 10, which was 120. So no, which was 12. Depreciation was 12. So it was 120 over 10 years. So times that, 9. There was impairment, yes. Less impairment. Impairment was in the books of the associate. How much was the impairment loss? I think we were given. Impairment will interfere with the retained earnings. Check note 5. Check note 5. There was impairment of how much? So that one you cannot apportion. The impairment was affecting our investment as a whole. Less UPI and realized profits. Who sold to who? Nani aliuza? Because kama ilitoka kwa parent, tunatoa yote bila kwa portion. If the sale was from subsidiary, it's going to be a portion. Who sold? Upstream. Salama is the one who sold to the parent. So you will share the realized profit. 75% of unrealized profit we got. It was also 12. So there. UPI. UPI was also 12. So it means this is 9. Question. What you get there is the consolidated profits. Ngapi? 813,400 na online unapata ngapi? Hatujaleta ile ya nani? Wanaitwa nani? Hiyo associate, with them they made a loss. So of that 8, what's about 8? Less the loss which was made by that other company. Less post-acquisition loss of associates. They made a loss of how much? 150. So 150, and we're controlling what percentage? That they made a loss of 150. This is negative, remember? So that is how much? 45. So how much will it be? Our associate made a loss, so it must reduce that. So that one comes to how much? 768,400. So peleka pale kwa retained earnings. Si working ukienda kwa mtihani, you'll be wasting time. Hata unaweza kosa kuipata. Achana. 768 unless it is required. Then you bring the capital of minority. Non-controlling what? Interest. LCI. So NCI, we can also do a working outside. So I have a working outside there, and that one is not going to be very dangerous. So we want to check the capital of minority. Capital of minority. What was their fair value on the date of acquisition? Their market value, we were given somewhere. Because that was like their capital on that day. Their market share is like their capital. We were given somewhere, note number? 2. 144. So on the date of acquisition, their market value was 144, which is more or less of their capital. Then you add post-acquisition profits in Salama. You know, NCI are only in Salama. So in Salama, one, they will be controlling what percentage? 25. Because parent was controlling what percentage? 75. So they control 25%. So 25% into brackets, shortly. 358, the difference in profit. 358 minus close to 34. Still? Yes. So that difference gives them 25. I remember parent got 90. They get 31. Then there was that depreciation element. So less depreciation. Depreciation was 120. So minority will suffer 25%. That also UPI unrealized profit walikaa hapo wakipengea wapi? No, depreciation was 12, right? Steve, yes. 120 was the devaluation. So that is 12. Sorry. So UPI is also 3, so minority will also get that. Wao pia watu wakilipwa wasiende bila kitu. How much? 169,000. Full stop. Weka pale kwa equity. Take it to equity. Take it to equity as 169,000. These two inasumbuka wanafunzi sana. Ukiona you are not friends, hata mdali wachane naye. Add for me that. Add for me that. How much is that, the total? $2027, 400. Full stop. Let's go to non-current liabilities. Non-current liabilities down there. Non-current liabilities, we have 8% redeemable. Redeemable preference. You earn for 60 plus 40. That is 500. Then current liabilities. Current liabilities, we have what? Payables, you earn, but remember to subtract the intergroup debts. Lakini payables kuna pesa ilishalipwa, si ndio? So hiyo usilete hapa. So payables is what plus what? 442 plus minus the intergroup debt was 34. You remember? 34. Intergroup debt was 34. So this one will be how much? Napata ngapi? 575. Current tax. The last one. Current tax. You earn. $52,800. We are in our workings. How much? $160. Can you check whether it is balancing with our total assets? So total equity and liabilities. Because how? Oh, as usual. Kawaida is 32. Na imagine walikuwa wanapeana ukipata 4 ticks you have to get 8 marks. Ilikuwa 8 marks. The balance sheet. Yes. Only 4 ticks. Hizo form hizi pata. Even without struggling, si ukipata hii na upata hii. Hebu sema ingine. Mtu angepata. By the time unaenda mtihani, hivi unafaa upate, hivi unafaa upate, hivi unafaa upate. Without problems. Hata PPE hainanga issue kubwa as such. Haina maneno, ni venye tu watu wanaileteanga maneno. Kuna hii tulifanyanga na watu wadai ilikuwa inaleta issue but that is not an issue. Check for me question 4 of the last sitting but one. Last sitting but one should be December 2021. December 2021. Question number 4. Saturday we might extend from 4:30 up to around 7. We may extend. So learn that. Lakini klasi watu wataka kuona hiyo klasi. Ili sikwambia ndio watu wanajua. So let me join you in the reading. On 1st of July 2021, Rangi Limited acquired the following in Missouri. 80% of the ordinary share capital of Missouri for how much? 20,560. Half of the 10% debentures. The summarized financial statements of Rangi and Missouri for the year ended this were as follows. So profit account, as you guys can see. Statement of financial position also you can see. The fair value of the assets of Missouri at the date of acquisition were the same as their book values, except for an item of plant whose fair value was more by 6.4. See the revaluation? Yes. The plant had the remaining useful life for how many years? 4 years. Depreciation, fine. How much wants to collect information as we move? So we can be collecting as we move. Yes, so let's collect the information as we move. So you start by saying revaluation. No. There's something very important. Actually, that's why I wanted this question. When a subsidiary was acquired within the space of the year, a year is how many months? 12. So if a subsidiary is acquired within the period of that 12, like this, and please listen to this, when you wanakunywa chai, watakunywa chai. So like kuna wanakunywa chai sahi. Umejua aje? Oh, umewahi kuwa hapo. Umewahi kuwa hapo. Na chai ikiwa hapo kando. So chai ya sahi, nani nakunywa chai Joshua? So if a subsidiary is acquired within somewhere, let's say here, and you are required to prepare P&L, profit and loss account, you only consider this period. From here, inaitwa post acquisition, from here to here. Very sensitive. Hiyo kitu nafanyanga watu wanaangukanga P&L kwa group. Mtu anaenda kwa tuna app. Unapata mtu ameenda kwa exam ana app this plus this, this plus this. Unapata 0. So you be very keen for P&L, you check if it was acquired before the year started, then that one you are allowed to do what? To add. But if it was acquired within this space, you don't. You apportion, you time apportion. Come for example, cover the 6 months income and expenses, you take for how many months? 6 over what? 12. But to get a balance sheet you don't apportion. Even if the subsidiary was acquired in the morning, you take in full. Where's the motor vehicle times 9 months? So motor vehicle uko nayo in full. Ama unaweza apportionia TED ilikuwa hapana. So balance sheet is never apportioned regardless of when it was acquired. But P&L, if it was acquired within, then you time apportion. Tumeelewana? So even before we start anything, hebu tuangalie hiyo kitu inaletanga issue kubwa sana. When is the financial statements year ending? Always check when it is ending to guide you to know when it should start. It is ending on 30th September 2021. For a financial year, to end on 30th September, it should start when? 1st October. Unaangalia kesho. 1st October of 2020. When was the subsidiary acquired? Check when it was acquired, where the question started. Check when the subsidiary was acquired, where the question starts. 1st January 2021. Steve hajaona ndio maana nasisitiza. I've seen it. 1st January 2021. It is within. Siko hapo ndani. Si January iko somewhere here. So P&L, profit account, all the income and expenses of the subsidiary, yes, income and expenses of the subsidiary You only take post what? Acquisition. It makes sense. Si hata mtu akioa, when you marry, still, when you acquire, and the wife, God bless, the wife is working, si revenue itakuwa inakuja. So if you marry the month sahi, umeoa sahi ni July, ukioa July, si hiyo revenue yake utaenjoy from July ikiendelea. Will you tell her, bring the ones you are getting even in January when she was not there? No. And because she cannot give you she cannot disclose what she was earning before acquisition, peer expenses zenye aliinka before acquisition, asikuja kuambia unajua nilikuwa na shughuli kwa nywele, compensate. No. You are only entitled to expenses after what? Acquisition. So income and expenses, you are portion. Lakini kama alikuwa naishi peke yake na umechukua vitu zako na zake umeweka pamoja, ameleta TV, sasa mko na TV mbili, moja kwa sitting room na nyingine kwa bedroom, sio? Yake ndio inapelekwa huko juu. So unasema hii TV tunamultiply na 6/12? In full, sio? So that means assets and liabilities are never done what? A portion for time factor. But for P&L, you be very sensitive. The parent is only entitled to recognize the revenue and obligated to share the expenses for the period when they acquired the what? The subsidiary. Then there's a very big mistake. I have seen people doing it. For example, subsidiary was acquired in 2019. Unapata wazimu mwingine anakuja hapo sasa sema this is 2 years. Anachukua revenue of subsidiary times 2. Every year they do consolidate. So if it was acquired before the commencement of this year, then you take them in full without multiplying or apportioning. Tuko sawa? So hiyo tu ndio inakuanga trick ya P&L kwa group. Once you identify that, you are safe. So our subsidiary is how many months old? 9 months. From January to September, 9 months. So actually, tuandike tu mahali. We have said we want to collect information. So collect it by saying this. Nzuri is equals to 9 months what? Subsidiary. 9 months subsidiary. So how will you consolidate? Consolidated statement of P&L. CSPL. CSPL is the consolidated statement of profit and loss. You will take Rangi in full plus Nzuri. Nzuri you will be apportioning for how many months? 9/12. Then CSFP. CSFP is which one? Consolidated statement of financial position. You will take Rangi in full, Nzuri also in what? Full, without apportionment. So that is very important for your whatever. Why are you yawning? Usingizi, uchovu, njaa. Steve, just say. Yes. Huh? Wale unajifanya hapa mzungu. Be like Steve. Every 2 hours. And your last meal was yesterday at 8. 10 a.m. Mpaka saa hii. Kwa sababu ya kukula. Steve. Hiyo ndio kweli. So evaluation. So we are starting with note 1. We want to collect information. Evaluation note 1. We read note 1 and there was evaluation of 6.4. 6.4 is like 6,400 because they are working in thousands. So that is 6,400, and it was being depreciated. Sure. For how many years?
4 years.
4 years. So depreciation will be 64 divided by 4 years. But you know depreciation is an expense. So you will consider that expense for how many months? For 9 months. For 9 months. How much is that? But guess what? Mtapita mtihani. You will pass, panic on it. $1,200. So this is 12. Let's go to note 2. I just want us to collect information. By the time we have a lot of information. Number 2, during post-acquisition period, that is after acquisition, intercompany trading that occurred include Rangi sold goods to Nzuri for 12 million. They never talked well. They sold goods worth 12. That is called intergroup sales. So intergroup sales is 12 million, which is 12,000. It should be eliminated during consolidation against group sales. So intergroup sales 12. These goods had cost Rangi 18 million. Had cost Rangi 18 million. So it means when Rangi sold at a loss. So yeah. Nzuri sold some of these goods purchased from Rangi at 20 million for 30 million. Ile price wanaenda kuiuza huko is not our issue. Sure. So there is no UPI at all. Because those people, first of all, they sold at a loss. The goods cost them 18 and they sold it at what? 12. So there is no unrealized profit. No. Hapo ndio examiner aliandika vitu mbaya in that question. They are not straight. Let's go to number 3. Let's go to number 3. Tunafanya klasi ya mwisho, kila mtu anafaa kuja hapa physical, sio? Tuone IV ni nani? Who is Collins? Joshua ni nani? Who is Jemima? Aisha? Because it's good to know each other. Naweza enda mahali kama kuna mwalimu alikuwa amekaa kwa matatu hataki kulipa fare, alafu amesikia mtu anamwambia hapo nyuma, mwalimu acha tu nitakulipia. Na hiyo ndio hiyo. Ati unanifunza online. So we need to know each other. Number 3, so you are required to come here so that we see you. On 30th of June 2021, Rangi and Nzuri paid dividends of 2 million and 1 million respectively. That one has no problem. They paid dividends, no problem. Note 4. Included in the trade receivable and accounts payable is 1.5 billion amount Nzuri owed. So intergroup debts. Intergroup debts. Intergroup debts is 15. Subtract from receivables. And you also subtract it from where? Payables. So you subtract from both. All right, let's go to number 5. Goodwill is considered to be impaired by what percentage? 25. Goodwill impaired is classified as an administrative expense. So it means ukishapata impairment, ukienda kwa consolidation, hata kila siku, that is what happens. Impairment is classified under what? Admin. So let's calculate goodwill, then we impair goodwill by 25%. So this is partial method. There was no fair value of the makers. So tuende kazi sasa. So start by saying, we want to start by calculating that goodwill. So let's start with goodwill. Let's start with goodwill. So goodwill, this is how it will be calculated. Purchase consideration. Purchase consideration. Purchase consideration. How much did we invest? Check where the question started, bullet 1. 80% of ordinary share capital we invested how much? 20? 60. Mambo ya half of the debentures you wachana nayo. Debentures una invest ndio upate interest. Hiyo ni loan. So this is the purchase consideration. I want us to subtract the net assets. So less net assets acquired. Less net assets acquired. Net assets acquired are the equity components. Equity components. Yes. So equity components are the ordinary share capital. So check ordinary share capital of that company. In their balance sheet, check their balance sheet. Check their balance sheet. In their balance sheet, ordinary share capital, you're seeing how much? I'm seeing 4. 4. Then they have retained earnings, but retained earnings, I cautioned you. Retained earnings, you check on the date of acquisition. Profit and revaluation, you check on the date of acquisition. You know, those ones keeps on changing. Share capital, I change, you know, constant in the car. So that's why we just pick it. But retained earnings and revaluation, they keep on changing. So check, because the rule is goodwill must always be computed on the date of Steve, the date of acquisition. Goodwill is computed. Rose, unaniangalia ni kama kwani goodwill inaangaliwa siku gani? Sio on acquisition. Nilisema hata msichana akienda kuolewa. Sio siku ndio unaenda hapo ati unaambia parents of the lady that God works in different ways. I've found someone, I've never seen someone like this. Huh? That one you are recognizing what? Goodwill. You are recognizing goodwill. Then after that, you start assessing impairment. As time goes by, naangalia impairment. Alafu siku moja unamwambia I wish. So you I wish the impairment has been assessed. So goodwill is checked on the date of acquisition, not closing. So I know the subsidiary was acquired within the year. They cannot give us that retained earnings. So we have to look for it. Subsidiary was acquired here. Sure. So you have to check the profit which was on this date. We can get. Check for me the P&L of the subsidiary. P&L of the subsidiary. The subsidiary made how much profit for the year? That after tax. For the entire year, 6,000. You can see 6 somewhere there. Subsidiary made 6 for the whole year. But the profit I want is here. So if we time a portion, can you time a portion this? 9 months, we got the space. Check, actually that is the easiest. Check 6 times. But wait a bit. Check note number 3. Check note 3. On this, Rangi and Nzuri paid dividends of 2 and 1 million respectively. Nzuri walipa dividends. No? Now your dividends are only for P&L because the dividends will reduce profit. So their correct profit should be 6 minus 1 for the dividends. So that is 5. Eh? So take 5 times 9 over 12. You put the profit from here to here. How much? 5 times 9 over 12. 37.50. So it means from the date of acquisition from here to here, they made 37.50. What was their closing profit? When we say closing, you check balance sheet. Check the retained earnings in the balance sheet of that company. How much is the retained earnings? 16,800. So to get here, simple. Take 16 minus 37, what? 50. So you need minus, you'll get the profit which was there. So sometimes our paying, if they don't give you that, is what you do. So you take 16,800 at the end minus what? Minus 6 minus 1 times 9 over 12. So where is subtract direct? We pass your figure. How much is that? Yeah. 13,050. 13,050. Revaluation was how much on acquisition? How much was revaluation? 60, 64. But their dividends, that dividend will also be accounted for, but pre-acquisition. Okay. Check here before we forget. These people paid dividends for the whole year. Subsidiary paid dividend for the whole year of how much? 1. But the acquisition took place here. So the proportionate value of dividends, because parent was not there within this space, these 3 months they were not there. So the dividends for 3 months, from here to here, they must compensate. So they were not there for this space. So that one will be part of the net assets. So you come here and say dividends on acquisition. Those dividends will be part of net asset, but for 3 months. The one for 3 months is the one they need to compensate. Hiyo ingine itakuja kama they are part of the group. That is 250. Kindly add. Add for me the entire. But sometimes I tell students, kama hujaulizwa goodwill hata afadhali wachane nayo pia. How much is that? $23? Online mtu anapata ngapi? Jinaona Rosa anapata na kasirika. 23,700. So this is 20. Kwani tutakuwa negative goodwill? Ama kuna kitu? Oh, niko sawa. 23,700. But this was partial. We take what percentage? 80% of the net asset. Parent never acquired everything. They only acquired 80%. So take 80% of that. 80% of that 23,700 comes so much? 18,960. Subtract. The difference is goodwill. So 20,560 minus the answer. I'm getting goodwill of 1,600. So goodwill is 16. But they have said there is impairment. So write down there, I'm proceeding the other side, write less impairment. Less impairment. Goodwill is impaired by how much? They said 25%. So less impairment 25%. 25%. So 25% of that is how much? 400. So net goodwill, which you will take to CSFP, the consolidated statement of financial position, will be 16 minus the answer, which is 1200. So this one will go to the balance sheet. This one will go to administrative. That one will go to admin. The 400. 400 will go to administrative. So, so we can kick off the P&L. So right there, Rangi Group, consolidated statement of P&L. Hebu chart tuone kwenye tunaweza fika. Steve, yes, the one I prepare was the last. This is the last Friday in your phone. Alright, so we kick off. Copy that. Unaona hiyo P&L yao. Una concentrate tu hapo. So go to their P&L. Are you seeing revenue? So revenue. And by the way, are you people reading that handout? Ile theory handout. Are you reading? Those of you started. Make sure we saw mpaka we master properly. Swali la baba. Haya, revenue 130 plus 40 what? Times 9 over 1 over 9 over 12. The subsidiary was 9 months old, so we say, and that's how it's done. P&L your portion for the post acquisition. 9 over 12 minus anything they sold amongst themselves. You see sell and we are losing power. So less intergroup sales. Intergroup sales, I remember. There was sale of goods from who to who. The 12. You remember the 12? Yes. Total. Intergroup sales, we subtract. So can you give me the entire? Chap. So the entire will be 154,000. So this is 154,000. Cost of sales. Cost of sales 90 plus 40 times 9/12 minus intergroup cost of sales. Check here. Check here, please. Though I'll not repeat this in any other question. I'll be taking direct. Randy sold to Missouri. Goods worth how much? So the other goods worth 12. So in the books of Randy recorded this one as what? A sale. And that is why we subtracted it here. Hakuna sale within group. Hiyo ni uongo. Then these people in Missouri recorded this 12 as what? No, as a purchase. So a purchase, when you check cost of sales is opening stock plus what? Purchases minus closing. Yeah? So purchases is a direct component of what? Cost of sales. So whenever there is intergroup sales, there is always the cost of what? Sales, automatic. But now it will be 12 minus the unrealized what? Profit to get the cost. Cost must be below the sales value. But fortunately, the unrealized profit in this question was 0. It was sold at a loss from the beginning. So it means the cost still remains how much? 12. So total minus 12. Then there was depreciation. Depreciation unless otherwise. Depreciation is classified as part of cost of what? Sales. Is an expense which should be classified here in group accounts. How much was our intergroup, our depreciation? We calculated 1200. So plus 1200. I'm adding because it should be is an expense which should be classified in cost of sales. Give me that figure. 40 times 75 plus 90 minus 12 minus 12, no, plus 12. I'm getting 109,200. Check to confirm. Iko hivyo? Yes. 109,200. Gross profit will be revenue minus the cost of sales. So 154 minus the answer, get 44,800. Correct? Proceed, just proceed with that format. Other income, interest received. So we have interest received. We received interest worth how much? We received interest worth how much? It's 150. Are you in the schedule? Are you seeing 150? So we received 150 of interest. However, any interest which came internally to Natoa, we remove because that is called intergroup interest income. Check for me where the acquisition took place. Ile note ilikuwa inaongelea mambo ya acquisition. You are going to see something there. Are you seeing where acquisition took place? The parent invested in a half. Are you seeing a half of the 10% debentures of Missouri? If you invest in debentures, what are you expecting in return? What do you expect in return when you invest in debentures? In interest. So the interest they got from that investment in debentures should be subtracted from this one because that is an internal income. So can you go to non-current liabilities, check how much debentures was in Missouri, then you check parent got what interest. So in Missouri, the interest was being paid at what rate? 10% times a half. Half of the debentures in Missouri. Missouri had a debenture was how much? 4,000. Rose, are you seeing these things really? How much? 4,000. So how much did, but for 9 months. The interest, 10% was per annum. So times 9/12. Then 10% is per annum. So prorate the interest for 9/12. How much is remaining, Steve? 10% times 400 is 400. 4,000 is 400. Half of 400 is 300. 300 times 9/12. Are you sure? Okay, 4,000 by this is 400. Then parent invested in a half. Parent invested in a half. Half is 200 times 9/12, 150. So this one is 150. 150. So E150 will record the yote ilitoka ndani. The entire interest was just within. So nothing goes to consolidation. So the entire interest came in within. I was checking what came from out. Then there was dividends received. Even dividends will be killed. Dividends received. Subsidiary paid dividends worth how much? Check please. Subsidiary yet will deliver dividends worth how much? Because dividend paid by subsidiary parent must take their percentage. I'll stop exactly at 757. 1 million. Parent will take both because pre-acquisition will compensate for goodwill. So 80% of 1 million. That is how much? 800. Eh? Sorry. In the books of a recording, 800. So you pay yote imetoka ndani. 80% of what we received from inside. So there is nothing. The entire dividends was still within the group. Proceed. Expenses. We have distribution. Distribution has no story, just add. 9 plus 2. But 2 times 9/12. How much is that? Yep. 6,900. Wrong. Come on, take 9,000. 91. See. Admin will be 7,000 plus 200, 9/12. But we were told to classify impairment. You remember impairment? Impairment was 400. Impairment we got 400. So you take 275, 150 plus 7 plus 400. 75, 50. 75, 50. Then we have finance costs. Finance costs will be 0 plus 400 times 9/12 minus. Unaona hiyo finance cost 150 they are paying. So the subsidiary wanalipa. Of what they are paying, 150 went to the parent. So you 150. Unajua finance cost the interest. So parent of a record receipt now wanalika pay. So the total they are paying, 150 went to the parent. So that is 400 times 75 That is 300 minus 150. That is one what? That is 150. Therefore, profit before tax will be 44,800 minus 9150 minus 7550 minus 150. 27,950. Income tax also you add 6,000 plus 12, but 12 times 9 over 12. Plus 6,000, 69. So profit for the year after tax, PAT, is 27,950 minus the answer. You get 21,050. Then that profit you share between parent and subsidiary. So you say profit attributable to inaishia hapo parent, then NCI. You distribute this profit to these two. You distribute that profit to the two. Allow me just to finish, because ni NCI peke yake tuna compute, then tunapatia parent the difference. Ana si ngumu. It's very easy. So the profit which will go to NCI, hebu tufanye hiyo working hapa ije kidogo. NCI wako kwa subsidiary. So then they take the profit after tax in the subsidiary, not consolidated. So NCI's profit. So you come and say profit of Mzuri. Profit of Mzuri was how much? NCI are in the subsidiary. Mzuri's profit was 6, sure. But I will take 6 for how many months? 9 over 12. That one is equivalent of 40 what? 45. 9 over 12 inakuwa 0.75. Instead of 9 divide 0.75 times 6. Less depreciation. There was depreciation. About how much? 12. Hakuna UPI today. So the correct profit is how much? So minus 12. 33. So this is the post-acquisition profit. NCI will take what percentage? 20. You know NCI was subsidiary. So they take 20% of that profit. So 20% of that profit is how much? 660. 660. That is what goes to the minority. So you come here and say NCI goes with 660. So parent will take the total 21,050 minus 660. That is what goes to the parent. This total consolidated minus what goes to the minority. So 21,050 minus the answer, you get 20. Rewards 390. 21,050. So when we meet in the next class, we shall do the balance sheet. Then we are good. Thank you. You can log out.
Along with section 3. 65 highly gross.
Yes.
Good. Naona hesabu mwezi hata
Anashtuka.